The information provided in this video is for educational and informational purposes only and should not be considered financial, investment, tax, or legal advice. Investing involves risk, including the possible loss of the principal. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The opinions expressed are those of the host and the guests and do not necessarily reflect the views of any affiliated organizations. Okay, guys, it's the Friday the 22nd of May, 2026. A pretty healthy week for stocks, we have to admit. Looks like fears of any calamities from the oil market seem to be subsiding. I think we have oil trading back down $100. It's pretty much it was a pretty flat market for the USA. It was S&P up about maybe 0.5%, but we had the Euro stock up about 2.5%. So just looking at the US, John, during the week, what do you think were the main drivers of the movement up?
Hey, Phil, Jeff, morning again. Yeah, the big news this week from the US was probably the earnings release from NVIDIA. They were blowout across the board. It's a $5 trillion company, and their share price kind of stood still. Again, it just shows the expectations built into NVIDIA. You know, that they massively turn up with a beat on their earnings expectations, and still the share price is flat. But this again it is confirming that the AI sector seems to be doing okay, and you know, all the alarm bells that were ringing before Christmas, they're still there in the background. But you know, it seems like the AI sector may have a few legs to run yet. It's hard to know. It's an unknown. You know, there's nothing really to compare this with. But my feeling is, yeah, AI is here to stay, and AI is only going to become more important in everyday life and in business.
And I guess as well, NVIDIA is very much involved in that whole AI sector, right?
Yeah, NVIDIA is the AI sector. It's the chip sector. They say basically everybody's paying rent to NVIDIA for their chips. That's what's going on at the moment. Elon Musk, he doesn't refer to GPUs anymore. He just GPUs and NVIDIA GPUs, the same thing. They're the graphical processing units that NVIDIA produce that are essential for AI. And you know, at the moment, they're the only game in town. Will the Chinese companies catch up? Yes, they will sometime, but maybe not for 2, 3, 4 years. It's hard to know. It's hard to know what's going to catch up and who's going to compete with them in the future. But
well,
for
they
now,
have such a fantastic, they have such a fantastic head start that they really have the game for the next few years, as you say, until somebody else catches up.
Yeah, and they are always improving. Every year they're bringing out new chips, or every 18 months they're bringing out new chips, and they're probably going to continue this pattern up. Their latest edition is going to be the Vera Rubins, you know, named after an astronomer who, not black holes, it was dark matter. That's what it was. Yeah, wow. There was something in there. So again, yeah, I can't see them going away. But at a £5 trillion valuation, are they going to double from here? Yeah, very likely. But you know, are they going to half from here? Very likely. They're going to do something, and you know, they'll keep going up until someone competes with them, and then there'll be a bit of competition. Prices will get driven down. So you know, are they fair value here? I'm not buying them. I'm not selling them. I'm just sitting on the fence.
Good call. Okay, Jeff. In Europe, with the XXP, God, there was a real broad rally here, wasn't there? You can see nearly everything is up. Well, actually, everything is up in terms of the sectors. Especially tech had a massive run around 6.
I probably find a few stocks that I have that are down.
Okay. So everything else, everything except
you're right.
stocks.
It was kind of broad based. I mean, you can see the tech outperforming. A lot of that, I think, though, ASML is a big hitter in there, and I think also. Is it Infineon? I think they're doing fairly well. They're on a bit of a streak too. So they're the tech or chip firm out of Germany. So yeah, the tech sector outperforming. The banks obviously showing, you know, that the healthy economy as well, or the belief that there's value there, you know, and there probably is. But you say it's a broad based rally, really, yeah.
It's actually broad based. Would you say ASML, by the way, is the equivalent of NVIDIA? Is it the European equivalent, so to speak?
Yeah,
as a stock?
yeah, I think it is. It's very much representative of it makes the machines that make the chips really. So it's very, very high tech, super expensive machines that need crews to work them and train them. And yeah, I think as well, just it is up near its highs probably, I think over the last, probably all-time highs, but I'd say that'll keep trucking up as well. It's one that, of course, if there's a change in sentiment of the AI sector and they hit everything, but if they don't, yeah, that's going to keep trucking on too.
Nice one. I was just looking at the US bond markets were flashing signals during the week. Well, during the past few weeks, that something's up with the consumer in the States. I think we had the 10-year hit about 4.6%, which was sort of flashing alarm signals to some traders saying, what's going on here? Because the bond market really does run everything. It's the core of the whole market. However, the stock market seems to be ignoring it completely. Do you have any thoughts on this, John, or have you been noticing yourself? Okay.
Yeah, I was going to say I've seen crashes before, and the bond market is usually the one that kind of, this is where the warning signs come from. Bonds are the cost of money. If you're putting money into the exchange and you're getting 2 or 3% return, and you can get 3 or 4% return on the bonds, you're going to switch it from equities into bonds and get your 3 or 4%. So when bond yields go up, the interest rates that you receive from owning the bonds, then the expectations are the money you need to get from your shares needs to go up as well. So when bond yields go up, it generally drags the price of shares down because you to match the bonds, you need to be buying these things cheaper. So again, with yields slowly creeping up and the market's still in all-time highs, there's quite a few sectors I'm worried about at the moment, and I'm probably going to sit in the fence or just look at them for a while because I think there's a bit of euphoria out there, and a rising sea floats all boats kind of thing, even ones that should be sinking. So I think the bond market going up is a warning signal, and I think you got to be careful what sectors you put your money into at this stage.
Do you think, Jeff, with the forward-looking aspects of some of these stocks and shares, especially in the tech sector in the USA, that they're overriding the yield curve? They're actually saying, well, okay, the bonds might get me 4% over 10 years, 4.1%, but these tech shares will get me a hell of a lot more. So they're nearly
Well,
ignoring
but
it.
on that one, Phil, all you have to do is look back over the last 5, 10, whatever amount of years, and if you put money in your tech stocks or, any relation to tech stocks and a lot of other broad-based US stocks in particular, they've just outperformed the bonds massively, so with yields here, I mean, I think about a year and a half ago, we were touching 5%, 5.3, 5.1 maybe in the 10-year in the US. It's only getting to be just sort of flashing there for people kind of as a warning that yeah, yields could keep going higher there, I think the global governments or they can put pressure on the US, well, I say government, but let's call some, certainly if Donald Trump's making too many crazy decisions, they can start to, maybe not buy so many treasuries or sell a little bit. And it is a way of maybe keeping that in check, So if for example, if things kick on with Iran a bit, and the rest of the world's not that happy, they can, hit the bond market a bit. And that's that kind of keeps the US in check a bit, because obviously if that goes higher and higher, the debt repayments are massive.
Also, as well, what you're talking about there, Jeff, that's one of the things they do when they stop buying US bonds. They're looking for a safe haven to put their money. And India and China have actually used gold for that sometimes. So it's a kind of subtle way of doing it. I mean, everybody in the government knows what's going on, but it's not blowing up in the news because it's not like an outlandish statement made by one side or the other. It's just a subtle way of doing it.
Yeah.
But again, everybody's aware this is what's going on.
Yeah. Well, I guess on
that's why we're looking at gold at the moment.
Yeah, well, I think the gold thing as well. I mean, if you take again the US or Europe, and they're going to print money, particularly with the US, you're going to keep buying bonds if they're printing money. That's where you put it into the gold and stuff. And Yeah, you hold back on buying as many treasuries.
Fair enough. Fair enough. Okay, guys, thanks for that. Right,
So
a question came in from Jonathan. This is to either Jeff or John, but I think that Jeff, you're famous for never having carried a loss. So John, you might have some experience with this. He has a portfolio.
Oh,
It's approximately about 40,000 euros. What happened was he locked in a loss last year. Now the loss was only about 4 or 5,000 euros, but he locked it in. And this year, so far up to May, he's made a profit of about 2,500, which he also wants to lock in. Can he offset the profit this year against the losses last year within Ireland, or is there some time that you can't go back any further? Do you have any experience with this yourself?
I do, yeah. In Ireland, you can offset your profits this year against losses from previous years. And in Ireland, there's no time limit on how far you can go back. You will have to prove the losses. Obviously, you can't just say I lost money 5 years ago and I'm writing it off this year. Uh, if you make a profit and a loss, you have to report both.
So you have to report the profit this year on your form,
Yes.
but then also you have to. But wouldn't you have done the loss last year? So you have to do the loss the previous year on the previous year's form, so to speak.
Yes. Well, you don't actually have to report the loss last year. You can report the loss this year on your form this year, but you will need proof of it. And revenue, if it's a small amount, they're not fussed, I guess. I don't actually know, but
Famous last words.
yeah.
You haven't a clue there. There's a guy sitting there going, hang on a second. That doesn't add up.
So yeah, basically, if you're claiming a loss from a previous year, you just have to show where you could be asked to show where it came from, but there's a chance they may not ask for it. So you made 2.5 grand this year, fill your CG1 form out, say you made your money, and then fill out the form and say, yes, I'm including money I lost 2 years ago, so I'm offsetting one against the other. It's straightforward enough, and there's no time limit on how far you can go back in Ireland on
Fantastic.
losses. There is a small little caveat if you're from the UK. If you're from the UK, you have to report the loss within 4 years, or else you can't claim it against a current profit. So that doesn't apply in Ireland, though.
Okay,
That's pretty much it. And again, I'm not a tax advisor. This is from my own personal experience.
all right.
Again, I'm quite good at locking in losses.
I just want to
Yeah,
clarify here. Is John a tax advisor or not?
No.
all right. Thanks for that, John. Okay, so let's just move on to the portfolios. Pretty stellar for you guys. We have John up your total return to date about 6.7 versus the market is about 2.85. Jeff, you're up 5%. Again, quite similar against the market, about 2.8. And Muggins here is down 1.8% with the market return of 1.59. So we're just going on the short-term trades. John, just looking at Puma, it's had a good run here since the 27th of March. So that's about 60 days, up 22-ish%. Actually, Jeff, probably you'd be better off commenting on this. What's the strategy here? Did you guys have an out price or what's your plan?
Yep. Help me on that. Yeah, no, it's doing nicely. Look, we bought it for a reason. There was a large buyer taking a big chunk privately. I think it was about nearly 30%. And also then we said that there was another person, was the ex-owner of Newcastle Football Club, was starting to purchase it as well. So look, it's heading up. I mean, which is kind of nice, I suppose.
Okay,
do you
so
take something off the table or do you just let it run? Well, that's
a
a
big
$60 million question, isn't it? Or
yeah,
$6 million question?
where was your out though? Where were previously before you put the trade on? Where was your perspective out, so to speak?
Well, I think if the guy was buying that chunk around 35, 36, something like that. Now it's a Chinese company. They're doing it for a certain reason, and they're buying a big amount privately, and obviously you probably have to overpay for that because you're buying it, you're demanding it. So I would have thought 31, 32 could be very comfortable.
Okay.
As a short term, as you say, well, we put it on the end of March. That would be quite comfortable. But I think if it did push, if there was a push into the month end now, I might take half off the table.
Okay.
But if I take half off the table, it means it's going to go higher.
Okay, perfect. So
That's
take half off the
100%.
table and let the other half rise. Okay,
Yeah.
that's great. So we'll find out by the end of next week where we're heading into the month. John, in Vivendi, let's see, we've had it on for about 30 days so far. How's she looking? She's up about 3%. This was part of the Universal Music Group trade, right? Or
Yeah,
company.
it's similar to Puma. We bought Puma and Vivendi both on good news, and we're kind of getting the back of that good news. Uh, the Vivendi spread between itself and UMG is actually narrowed a little bit, which is a really good sign. So
Mhm.
I kind of like this trade a little bit more now, and I'm probably going to be in it at least till the end of the year, unless something happens. You know, if nothing changes, yeah, I'll be in it for a while longer.
Okay,
And
perfect. All right, good stuff. And so looking at the long-term trades, Unilever
Well,
is
actually,
one I had.
just on that though, Phil, I think John, we were a bit offside in that as well, right?
yeah, we were
Even
actually.
after we bought it, so
Yeah, we
you'd be
definitely were.
kind of hoping that we get a little bit of a look at some upside, right? So
Yeah.
Yeah, but that
yeah.
always happens. You know, if you worry about the short term stuff,
Mm.
you shouldn't be trading. You know, you make your plan, you go with your plan. If it works, great, you learn from it. If it doesn't work, you learn from it, and you do it better next time. So
Okay. Well, the one lesson I have learned is that whatever Jeff says, just wait for 6 to 8% drop in the share, and then buy it in there. It just
There you
seems to
go.
be the best of it. Right. Looking at Unilever, that's what I had that one. Again, the reason I bought this was it's a very stable stock. It just sits around $50 forever, except when I bought it, of course, then it traded down to 46. But it's back up again. Um, its biggest worry was that if something did happen in the Middle East, it was going to be affected by that, obviously being a very high consumer stock and also utilizing a lot of oil for its products. Seems to be on the back of things waning in the Middle East. It seems to be just reaching back to 50. Look, this is something I'm just going to keep. It pays a good divvy. Divvy is about 3.84%. So this is something I'm just going to keep for. I can't see any reason now to sell out, to be honest. So I'm going to keep this. Other long-term trades, Accenture, Jeff. How's that doing? So you got this on
Yeah,
the 8th of May.
it's doing fine. As I say, I chatted to a guy, I think, and it was after John was talking about Cognizant,
Uh-huh.
and I note that Accenture are in the same kind of space-ish.
Right.
And he was kind of the guy I talked to seemed to think they were a good company, and he sort of knew something about it. So yeah, I said I'll put that in the pension portfolio for the long run. You know,
Okay,
just
fair
take it from
enough. And
there.
then good stuff. And then John, I was looking at Cognizant during the week. They seem to be hooking up with Google now, so they look like they're going the AI route as well, which is, of course, every firm is doing this. But that was just relatively recent news that they are maybe getting on board with Google. Do you have any comment on the stock itself? Is something you're just going to keep anyway?
well, I do. This is my catching a falling knife stock, which I normally don't
Oh,
do, but
alrighty.
I bought into the sector because it was coming down, looked cheap to me relative to their earnings. Uh, I kind of believe that Cognizant, Accenture, Salesforce, they're utilizing AI in quite a good way, but they're being penalized heavily for AI doing well because it's felt that AI is going to eat into their business model. I'm not sure if it is. I think it might be overdone, and that's why I bought into them. But again, when I bought the stock, I was almost 20% offside, you know, within a few weeks.
Mhm.
So again, it just goes to show the risk. If stock is falling, it can be in free fall. Even if it's good value, it can still go further, a lot further. It's very difficult to time a stock like that. But my plan here is to hang on to it for, you know, at least a year and
Yeah.
just monitor and just see how things are going and monitor its peers as well, see how they're getting on. And yeah, that's pretty much the plan there. I still
I
like
think
it.
I think also with the catching the floating knife strategy, my old boss he used to watch stocks like this, and he'd pick a level, and he just let it fall, and then he'd bring the level down maybe 2%, 3% every time it did fall, and that was the level he would get in as it's heading back up again. So he'd never try to catch the bottom of the curve. He would always try and say, look, if it goes back up again, I'm going to buy it. So sort of, it's a very patient trade. You just got to wait and wait and wait. And I think maybe we had that with this stock. It did take a big drop after we bought. Let's start to head back up again. So obviously, so far we're offside, but we're on the right side of the trade. So that's just my 2 cents on that. Okay, that's very good. So just moving on to the waiting room before we go on to the next topic. John, Puma is, look, I've obviously missed it. I'm 20%. It has to fall down before we even buy it. So it looks like that's not going to happen. Well, hopefully it won't for you guys. But John, you were looking at gold. Its current price is around 4,500. You were thinking about 42.75. You might relook at it, maybe add it to your portfolio. Have you changed your opinions currently at the moment, or how's that stand?
I haven't actually changed my opinions on gold. I'm looking a little bit more actively at it because I think some factors that I liked have increased. For example, I think the US people will be diverting money from dollars in the future. I think gold is where some of those dollars will end up going. So
Mhm.
yes, I'm looking at it more actively now, and likely if it stays around here, I'll probably be taking a position in the next few weeks.
Okay, perfect. All right, thank you very much. So today we were just going to have a quick conversation about bonds. This comes from, I was speaking to people last weekend who were talking about portfolios, and they kept talking about bonds. Now, we're all used to buying shares. Everyone understands how shares work. Bonds are they're more a hedge for shares. But really, people didn't have a clue or didn't really understand how they function. And the best thing I could think of, this is how I tried to explain it, was that we used to have a thing called savings accounts, which used to pay very good interest, relatively speaking, for saving money. And bonds behave that way. They pay what's called a coupon every year, which is a percent that you get for putting your money into bonds. John, can you just try and break it down that if you had bonds in your portfolio, so say you buy 10,000 worth of 10-year bonds, how does that work in terms of coupons
Okay,
and your
well,
money?
the good thing about bonds is they're tradable. So if you buy them, you can sell them out again. And anything you can buy and sell, the price can go up and down. Uh, the way a bond works is that you'll take 10 grand's worth of bonds. They'll pay a coupon, maybe 3%. It's like an interest rate. So it's like putting money into a bank, you get the interest rate. And that coupon is paid every year. And if it's a 10-year bond, at the end of 10 years, you'll have received coupons every year at 3%, if that's the coupon rate, and you'll get your money back. The 10 grand returns to you at the end of that 10 years, and you're free to do what you want with it at that stage. So it's essentially like a savings account. It's a way to kind of protect cash, or maybe you've got expenses coming up, and it's a way of keeping cash safe and easily accessible.
Okay, so if interest rates go higher, say over that 10 years, say they go from 3% to 8%, you only get 3% on your
You only
10,000.
get 3%. And to
Okay.
offset that, people think, well, it's a 10-year bond. I'm stuck in this 3% for the next 10 years. So the actual price of the bond will come down in that situation. Uh, you will get your full 10 grand back at the end of the 10 years, but
Okay.
you will miss out on getting 8%, which the market's currently paying for the remainder of the time. So that's why the share price, so that's why the price of the bond comes down in that situation.
Okay. There's two types of bonds. There's corporate and government. Government bonds seem to be the real safe ones, except for the financial crash, which government bonds unfortunately weren't that safe. But people do always talk about U.S. Treasuries. That's the United States Treasury, European Central Bank bonds, Irish bonds. Um, you're a portfolio provider in a pension. They can buy bonds quite easily for you as part of your portfolio. Jeff, have you looked at this at all? The ways of buying bonds, is it through a portfolio, or if you're doing your own portfolio, then you really can't buy bonds because of the quantity of money that you need to have. Is that true?
Well, I see. I suppose technically most people might have some kind of a PRSA or some contributory pension where they can select certain options of investment. And if they select more of a balanced fund, it will hold a lot of stocks, maybe 60%. It'll hold some gold. It'll hold maybe a tiny bit of property and, maybe 20, 30% in bonds. So you won't, you'll just contribute to that particular fund. But if you do trade your own pension, and there mightn't be that many people that do that, then you can buy whatever stocks you want in that pension. But then you can also buy into certain bond funds as well. I looked at one, I think it was a PIMCO global bond fund, and therefore you're buying into a whole basket of bonds. So you're getting a yield, let's say it's around, let's say 4%, maybe slightly less, but you're getting a yield of 4%. But as John mentioned earlier on, the price can go up or down. So in that, if you're more long term and the price of that goes down, it means you can now buy bonds at a lower level, which is a higher yield, and you will technically have made a loss in that. But these bond funds, like in a pension, if you keep adding into them and they keep rolling, eventually, that's all offset because your money's rolling in there all the time.
So it's more, it's more a time trade.
It's a time trade.
Really
so unless obviously if there's a huge move upwards in yield, then if you want to then release from that bond fund, you would take a loss. Yeah, you definitely you'd be selling at lower prices.
Okay, well, but also it strikes me, and this is someone else was trying to explain to people last weekend, is that if you have money lying around and you're a bit too nervous about the stock market, the bond market's the place to go, because you're better off getting something than getting nothing. The savings accounts are giving you nothing, current accounts.
Yeah, you're right, but I think depending, certainly we talked about earlier on, about the yields sort of heading down a bit. Sorry, yields heading up. Due to sort of environmental, economic situations. Therefore, if you keep the bonds you're buying, if you keep them really towards the shorter end of the curve, i.e. the 1, 2, 3 year area, that way you're not so susceptible to for the long run for changes in interest rates. If you're buying, 10, 15-year bonds, let's say 10, you might buy 15. You're locking in for quite a while, and throughout history, I think bond yields tend to move, in one direction. They can start trucking that way, if that makes sense. So
Yes.
if you buy a 2-year bond, as John mentioned earlier on, within 2 years, you're getting back your coupon payments plus your cash, and then you can roll it back into another 2-year or a 5-year or whatever if yields gone higher.
Okay, so just finally then on the bonds, if we're making a distinction between a pension, if you're whatever income you make off the bonds, this is including the interest rate, i.e. the coupon, is that's tax free in your pension, John? Is it? So you don't pay any tax on that.
It's tax free in your pension, but coupons, you pay tax at your marginal rate. And it's like if you have income over $5,000 from coupons, rental income, etc., you pay PRSI in that too, and you also pay USC in it too. So,
but not if it's in a pension. If it's in a pension,
not if it's in the pension. Again, the pension's the right place to do stuff like this.
Okay. Otherwise, you're just basically paying equivalent to income tax, really, and other taxations.
Exactly. And if you're on 40% income tax plus you add your PRSI and USC on top, you're giving half your profits away. The other side of it is the capital gains tax. If you buy Irish government bonds, there's no capital gains charge on any gains made there. If so, you buy an Irish Treasury bond, price goes up, you sell it, you make a profit, no tax, which is nice.
Yeah.
If you buy a regular bond, price goes up, you sell it, you pay CGT. Capital gains tax at 33%. Again, offsettable against other profits and losses you make.
Okay. And then just Jeff, last thing is corporate bonds. People were talking about this. A corporate bond is equivalent. It's like buying a share, really, isn't it? It's a company is looking. So say you have a big company like Cadbury's or something like that, and they want to raise money to do something. They issue these bonds to raise the money. They offer some sort of like yield or some sort of coupon. The bigger the company, the safer it is, obviously. But they really behave like a share, do they? In terms of
well, they do and they don't, Phil. Just if you own a share, you're an owner of the company.
Mm-hmm.
If you buy into the bonds, there's an obligation for payments to you, and you're probably, you're somewhere in the event of any kind of liquidation or trouble thing, you'd be getting your money back over the shareholders, right? So that's why it doesn't pay like a div. If you were to buy, I don't know what I mean. If you look at say something like Aviva, I think they pay around 6% dividend. But I don't know what you get in the bond. I must actually,
Okay.
I'll look into that because I'm kind of interested to see. But let's say you got maybe 5% in a 4-year bond or something like that. So you're already getting more in the dividend, plus you're technically you're getting into the upside too.
Right.
So yeah, I mean, the bond.
So it
is,
sort of sounds like something. It's more for the professionals. Would you say that?
well, it kind of
Professional
is,
traders.
but effectively, you mentioned there it's to do with the risk of the company as well. If you have a
Right.
company that's a very low risk, and all companies pretty much issue bonds, even if they've got big cash piles because they're investing that in other things. But if it's a very low risk company, I mean, the yield will be very low. So that just, again, people do that, or maybe large institutions, and they stick it in the pension fund thing I was talking about earlier on.
Okay.
And if effectively, yeah, that's it. Really.
Okay.
I think it's worth mentioning. Bonds are typically perceived as being safe havens, but I think we should mention Credit Suisse and what happened to them. They were offering bonds at 10% with a 10% coupon, and it seemed like free cash, and they went bust. They're and if you own those bonds, you got nothing back for them. So the actual money you're receiving in coupon, if you're getting more for your bonds in coupon than the actual interest rate, there's probably risk in there somewhere. Now,
Okay.
maybe you don't understand it, but the price of bonds is directly related to the risk attached to those bonds. So very high yielding or very high coupon paying bonds typically have higher risk. And Credit Suisse, again, around for over 100 years, people have no way that's gone bust. It went bust, and everybody lost whatever they had in there.
So that's why
Buyer beware.
government bonds tend to be cheap, because they're safe.
Well, just
Yeah,
but
well,
as John's,
not cheap. They pay a low
yeah,
coupon, a lower
but
coupon
as
Yeah.
because
John's
it's
saying
safe.
there
Yeah,
as well, it's
risk
all
and reward.
risk. It's risk and reward, right? I mean,
Yeah.
if you're looking for a 10% yield and you're thinking that's great, it's more risk. And the same thing if you're getting a dividend at 10% or dividend at 3%, well, why? Well, there's usually more risk in the higher dividend.
Yeah,
Okay.
just one thing. There is no free lunch. If you think you're onto 100% winner, this is gold. There's risk. There's always risk. The market is very well run. It's very efficient in most parts. If there's a big opportunity, if it looks too good to be true, it probably is. You might get away with it, but there is risk in every risk and price go hand in hand.
Okay, fair enough. Okay, well, considering that you bought me a large coffee and a lemon muffin yesterday, John, I would say that is a free lunch, to be honest. But
Oh, that's not
Right
lunch.
there.
That's
Not really
that's
lunch. No, it's not lunch at
that's
all.
Mincy's
Bill,
right.
so you can't use
midday
that. There's no
treats.
lunch there. Yeah.
Okay, fair enough. Okay, guys, that's great. Thanks a lot for that on bonds. And listen, next week we're going back to the stocks. So we're going to have a look at LVMH, which is Louis Vuitton Moet Hennessy. It's in the luxury sector. This is in France, Jeff. Is it a French stock? Obviously, or is it?
Yeah, I think
Dutch
Arno.
French.
Yeah, he's
Yeah.
there. That's French. Well, I mean, they are. Obviously, they've a makeup from a lot of different countries now, but typically, yeah, the baseline's France.
Yeah,
Okay,
baseline's
great.
France, hugely dependent on China though, as are all luxury goods nowadays.
Okay.
So again, they're based in France, and we're going to look at where they get all their cash from.
Right, and then we'll see then.
Not from this house.
Not from this house either.
Okay, and so then we're going to have a quick look at that, and we're going to see if it's worth buying or not, because it's quite a specific sector, the luxury sector, isn't it? I mean, it really is. It's quite a very specialized sector, I would think.
Yeah, and
So
it's been volatile enough lately as well.
okay,
Yeah.
okay, lads, that's perfect. Listen, thanks a lot for that, and we will
Oh,
speak to you next Friday. Okay.
okay, appreciate it,
Thank
Jeff,
you.
Phil. Thank you.
Thank you, guys.
Cheers, guys. Thanks a lot.
Bye.